Hello. Throughout first time engagements, we are often asked what does Moat actually mean, since it happens to be the name of our portfolio management service. So we thought it's high time we address this question and give you some basic background on economic moats, why it's important, and why is it such a central part of our investment strategy. So back in the days, moats were just depressions around a castle, usually filled with water, serving as a preliminary line of defense. And it really is the same with businesses. All businesses, especially the profitable ones, attract competition. It's pretty straightforward. If today I open up, say, a pizza joint down the street and I get famous pretty quickly with people lining up just to get in, I'm bound to attract competition. There's going to be another pizza parlor in the same locality, even in no time at all. The example may remind you of Subway. Seemed like everyone wanted the Subway chain's franchisee at some point of time. But coming back to the topic, the point is everyone wants to run a profitable business. But moats, basically economic moats, which is a term popularized by the legendary investor Warren Buffett, protects them from the competition that wants to move in and are trying to eat a share of their profit pool. As we spoke about earlier, if you look over long spans of time, highly profitable businesses tend to be less profitable over long periods of time as competition moves into their industry. Yet, some small fraction of businesses do manage to keep the competition at bay by building economic moats or competitive advantages which protects them from the competition and in turn allows them to maintain high returns on capital. In some cases, like Asian Paints, this high profitability stretches for decades as well. So, what does moat mean? It tells us the business's ability to maintain profitability even in the face of fierce competition. A sustainable competitive advantage is difficult to mimic or duplicate, and so it's safe to say that power of moats is immense. The wider a business's moat, the more likely is its ability to stand the test of time. This belief makes us look into particularly certain kinds of economic moats while analyzing any business. Like the first one is intangible assets. We cannot feel or hear it, but it's like an asset that gives the business pricing power, like brands, patents, and even regulatory approvals. You'll certainly pay around 1 to 1.5 lakh for a smartphone model if it comes in a white box with a half eaten Apple logo, wouldn't you? That is Apple for you. Apple's pricing power basically changes the consumer's behavior, and that is what defines a business's brand, making it a strong moat. Customer switching costs is the second one. And what it means is they are basically when it costs a lot of money in terms of time or labor or resources to move from one product to the other. Like when a customer would rather just pay a little bit more for the initially purchased product year after year, purely for the sake of convenience. The point is that any business that works hard for its consumers to switch, let's say, a complicated software program, would be switching cost that usually can extract some pricing power from consumers, making it a phenomenal moat. We have the third one, which is the network effect. Perhaps that's like the most powerful of all modes. When it occurs when the value of a product or service increases with the number of users. Zomato is a perfect example for the network effect. It works both ways. Customers use the food delivery app to get access to the majority of restaurants in their vicinity. While on the other side, we have these restaurants using the same app to serve a wider customer base. And so both parties benefit from the increasing usage of the app. Cost advantages sounds like business school 101, right? A low cost producer in a commodity business is definitely a competitive advantage. However, only some are more durable. There are process based cost advantages where a business comes up with a mousetrap or a better way of creating and selling a product or service, but tend not to be very durable for too long. Indigo's low cost airlines is an excellent example of this. This is where scale based cost advantages are different from process based cost advantages. The former only gets stronger as the company gets bigger. DHL, Express, or even Blue Dart has a very dense network of vehicles going all around the country delivering their packages. And so the incremental cost of putting one more package on that vehicle that is already going along a certain route is almost nothing. Needless to say, the incremental profit in that package becomes very, very high, and the cost advantage just gets bigger as the network gets denser and denser. Unlike many firms that focus more on established moats, we at Moat Financial Services are much more focused on firms that are still building their moats while reinvesting their capital back into the business with higher returns. In our view, the value of an economic moat is maximized when the business can reinvest back into themselves. An extended period of excess return on capital increases the business's value by lengthening the period during which capital can be reinvested. So, wide moat businesses have a long time period to reinvest capital back into the business at a high rate of return. On the other hand, with a no moat business, it only has a few years before a new competitor shows up, copying the business model and knocks up their product off the shelf. As an investor, your first goal should always be to find these competitively advantaged businesses that can compound at high rates over time. And this is why we are always on the lookout for businesses whose advantages are difficult to replicate. Some of the biggest clues actually lie in their financial statements.